Peter Rose, Longwood Currency Trading. What's a reasonable Forex profit target? The key here is the word reasonable. And there's two ways we can look at reasonable. One is from a structural standpoint. I mean, we all pick profit targets based on some sort of a support resistance concept, okay? That might even include a moving average. It could be that. But the other more critical aspect of that is what's reasonable for you. And you is like you as a trader in your experience, and what's reasonable for you in the current price action that's going on. You know, you could have a reasonable profit target 30 pips away, but from a structural standpoint, but from a price action standpoint, it might be 8, because you may be in a chop area where you're having about every 10 pips, you're having an 8 pip replacement. In other words, you just have very gradual climbing price. So there's a lot more to it than just looking at a chart and saying, oh, I think this will be the profit target. Now, with experience, and again, I qualify experience, a couple of hundred closed positions, maybe a year of trading or something like that. I mean, I don't mean to be glum about it, but you're not going to be a neurosurgeon in 6 weeks, and you're not going to learn how to currency trade in 6 weeks. So, not that the complexities of the two are the same. It's just an analogy. All right, don't get your shorts tight. Reasonableness has more to do with our view of the price action situation than it does identifying quantitative type targets. You know, is it a qualitative process? No, I don't think so. I don't think that would be a good term, but I think it's a value-based process in looking at a profit target. What's the value of the profit target in relationship to the risk that you're going to take? If you're looking at a 5 pip profit target and you have a 2 pip risk, you're not being reasonable about anything. If you're looking at a 300 pip profit target and you're looking at a 8 pip risk, you're probably not being reasonable either. And so looking at the reasonableness of something is not only structurally based, but also based on your ability as a trader to be able to trade your way to that profit target. If you've got enough real estate between your take point, maybe to do some staging, or at least bring your stop up first to a break-even point, and then maybe to lock in 3, 5, 8 pips or whatever of profit as the position moves. If you're all in, all out type of trading in your particular stage of your journey, and also if you're trading with any size. If you're trading under great volatility, you're not going to be looking for 20 or 30 pip profit targets unless the volatility is gone from an ATR of 80 to 260 or something. And then you just pick that swing and you jump in and ride it for 20 or 30 pips and then pull out. But in most issues of volatility, particularly if you're a day trader and you're down on the 5-minute chart, you'll be looking at 20 or 30 pips of volatility in 15 minutes. And that's a lot, because a 15-minute time chart on a some of the majors is going to be I don't know, 7 pips, Even on a 15-minute, might only be 7 pips. And so, if you're in that sort of volatility, where within a 10 or 15-minute period of time, you're going to have a 7 or 8 pip spurt or a 10 pip spurt, you could do a sizable trade. Maybe go in with 10 fulls or 8 fulls, because you're just going to go in and you're going to come out in a minute. But that minute could be 8 pips, right? So your risk of loss is smaller in a high volatility price action situation than it is in a low volatility. So if you have low volatility, you're probably not going to want to go in with a large sizable position. You're not going to want to back the truck up. You have to be careful about those profit targets. And generally what I do, and look, in all the videos that I've done, I talk about very static rules. I'm only going to take an 8 pip risk. I've got to have at least 20 pips for my profit target in order to warrant taking the trade. It has nothing to do with risk reward. It has to do with, if I'm going to have the price turn around on me, I don't want to have it go 15 pips to prove me wrong, that I'm in the wrong trade. I want to be out in 8 pips. I think an 8 pip on a 5-period ATR chart is plenty. If it's going to go 8 pips against me, it's going to go 80 pips against me. And so I just pick the 8 pips as so I don't have to worry about my risk. And I statically state I'm not going to go into the trade unless there's at least 20 pips. And so the danger there, and that's more of a guideline than it is a trading principle. What we're saying is you want to have at least enough real estate between where you're going to have your entry point and where you're going to be taking your profit to get a third of that distance, because it'll take you about a third of the way to convince you that your analysis of the price action is got you moving in the right direction. You also have an opportunity to judge the size of the candle as a differential between the ATR, for example, to give you an idea of your momentum. And then as price moves in your favor, we know that no price target is a line. You're not drawing a line in the sand. It's a zone. And that those zones could be, I mean, you're drawing the line. Obviously, you're connecting something together to create this zone. But that price action zone could be, remember, a resistant zone is an area where there's a lot of orders that are being sold, like prices going up. The people are taking their profits in that area. They're happy with that. Or the large institution, his client has said, we don't want you to pay more than this for the products that we're going to be buying. And so when he gets to that, when he's bought to that level, he goes, I'm done. Well, price may not come down all by itself, so he may take a quarter of his profits and dump that all in as sell orders at the same time, and then all the retail traders get out, and the other banks are saying, well, we'll take our profit here too, because the banks aren't looking for 30 pip profits. They're looking for 2 or 3 profits on $5 billion, right? So we're talking about 2 different purposes in our trading between a retail trader, right, and a bank trader. And so there are these zones, and they could be 5 or 6 pips on either side of that line that you drew. And wherever it is that you draw that line could be 3 to 5 pips off. So you could be looking at a 15 or 20, 10 pip aside breadth of the zone where you're going into. Well, if you get a 20 pip profit target and the zone is 10 pips aside against you, you've only got 10 pips to your real profit target zone, right? And so that has to be taken into consideration. You know, you say, well, this is a really strong resistant zone. Yeah, and the stronger that zone is, the more the number of touch points that there are, means that that zone is going to be bigger. It's more dependable, but it isn't dependable at a finite level. It's dependable that somewhere within that 20 pip spread, which is 10 pips on either side of wherever you drew your stupid line, that there's orders being executed at that level, and you're probably going to get scooped up. You could get scooped up 10 pips down from where your profit target is. So you have to look at those resistance zones. You have to evaluate those differently than you think you would. It's not as simple as trading zone to zone, level to level. Those levels mean something, and you have to take that into consideration. And so as a reasonable profit target, what would be reasonable? 30 pips for the day or a trade? I don't think you're going to get that. You may get something like that 10% of the time on one trade, on one position. If you're doing it linearly, if you're having price run against you and you're adding to your position negatively or on the rebound, whatever, you're lowering your average profit, your average price, and you can keep your profit target the same, and so you can do that. But do you really want to finesse it that way? Do you have the skill to do that? And so in the beginning, you have to learn it differently than you might execute when you have a little bit more skill. And I bring those topics up because, again, I don't teach beginners. I teach perhaps beginners who have already had some experience, but they're not getting the results that they would like to get. And then that's where I can probably help you out the best. But just getting started, you really have to pay attention to the videos, to the static rules and things that I propose, because that'll keep you safe until you can learn your craft, right? And so that's the story about judging these profit targets based on the number of touch points. The solidarity of that target makes the area larger. When you're just starting out as a trader, you draw the line and trade to within 3 pips of the line. That's the only way that you're going to do it. That's the only way that you're going to learn. And by experience, you'll say, "Oh, I get 5 pips to my profit target, and the thing kept going, and that keeps happening." Why does that keep happening? That's where you're going to learn. Not by me saying that the profit target could be 5 pips broad per side of the line, because you won't pay attention to that. You only pay attention to when you lose a couple of trades and you go, "Wait a minute. Oh, I remember Peter said that zones are profit targets, or resistance and support lines are zones." And so in looking at a reasonable profit target, then, do we really have, as short-term traders, reasonable profit targets? Yes, we do. Even when you're looking at that 20 pip profit target, you say, well, it's going to take us, say it's 20 pips. So a third of 20 pips is 6 pips. It's going to take us 1 5-minute bar, maybe 2, just to figure out whether that is a good profit target or not. And again, how you do your trade entry analysis doesn't necessarily mean that you're trying to catch. Let me put it this way. I sound very negative when I say, well, you're going to take maybe 2 5-minute bars to determine whether you're on the right track or not in order to get to a 20 pip profit target, because you've already lost 10 and you might have 5 on the side, so you're only going to get 5 pips. Well, that would be fine in and of itself if you had the discipline to pull it out 5 pips below the zone. But by setting the entry analysis, what you're really doing here is you're looking at the price action like at a swing point, or at the point where you've come down from a reversal and now it's starting to swing around and it's trying to come back. Well, before you get to your take point for your entry, that might be 5 bars. It really could be 5 bars, because a retracement on maybe, let's say a retracement on a trending 5-minute chart could be 15 pips. Okay, so you've retraced 15 pips, and now you've got probably 15 pips to go before you go over where that turn point was. That doesn't make that point. That, you know, you're going up and you come back down. That doesn't make this point here a resistance point. You're going up and it came back down, and you're going to go back up, and this does not count as a resistance zone. You have to determine what you're going to call a resistance zone. Where are you calling these resistance zones? Now that's a big issue here. You can't just go, oh, I'm on a 1 hour chart, I'm going to draw these lines, that's a resistance every hour. Hey, you can't do that. You can't do that. So in doing this, looking at this retracement from you got your price action, and it's going to go like this. So each one of these is not a zone. It's a minor zone. It's a suggestion. But anyway, you come off of that and you come down 15 pips. So you're going to have to go back up 15 pips before you get to your take point. So you've got plenty of time to see if the momentum is going to be sustained to keep that trend going, or whether that last one might have been a swing point. So by saying that you're losing 2 bars in determining the momentum to get to this 20 pip profit target is not correct. It's all in how you do your trade entry analysis, with that analysis of that price action as it comes off the resistance point. What are you going to do? You're going to buy as the thing swings over on you. You're going to buy after the thing has gone up without a retracement for a certain period of time. Where is your take point? How do you judge where your take point should be? All these things work in conjunction with each other in order to determine the reasonableness of the profit target that you're going to be taking. So if your profit target is 20 pips away, and you have 20 pip retracements, you've got to ask yourself, are you in a trend that you can do that particular methodology on? Or are you in a chop? And that changes the aspect of calculating what those profit targets should be dramatically. And so the term reasonable profit target has to come into your consideration of your trade entry analysis, because if it doesn't, you're kidding yourself. There's plenty of videos and books and stuff out there. Oh, you just draw this line here, and when the price gets pretty close to it, then you bring your stop up to here, and then you do this, and then you do that. It's not quite that simple. Though that's what you may do, there's a lot underneath the covers that you need to know and have experience doing. It's like driving a car, and if you're in the United States, for example, and they're taking a left-hand turn, you're taking a left-hand turn against traffic and oncoming traffic. And so it's not sufficient for the driver's ed instructor to say, oh, okay, make a left-hand turn up here, and you've never made a left-hand turn, or you only made 20 of them in your life. You've got to say, hey, wait, are there any oncoming cars? Are you at an orange light? Is there people in the crosswalk coming across from the other way as you're going to try to make your turn? Are there any kids throwing basketballs around that you may run into? Are there cars coming the other way that are making right-hand turns that are maybe coming too far into your area where you're going to have to make your turn? All those things you're going to have to know. So to say, oh, here's a resistant zone is stupid. And even if you were able to identify what that resistance zone was with the, with the spreads on either side of the line itself, it doesn't necessarily indicate that you've got a methodology to successfully trade that, or to determine where your entry point is as a function of the distance to that zone. And what are you going to do about retracements between the time when you are at your take point and the zone? How do you avoid a retracement where you're trying to get a 15 or 20 pip move to get your price? How do you avoid at that particular time going into another retracement? Those are the things that you learn in a course or from somebody who knows what they're doing, not from a freaking blog, and not from listening to these guys on videos who are just telling you what to do and how to do it, but they're not explaining when you need to do it. Those are the things that you need to look for in order to determine what a reasonable Forex profit target is. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.